Good morning to you as you're logging in. We have quite a few people joining us this morning, so if you bear with us for a moment or two, we'll just allow time for everybody to get logged in, but you're very welcome.
Morning, everyone.
Say good morning. If you've just joined us, we're just allowing another moment or two to let everybody get logged into the webinar, but you're very welcome this morning. Okay, we'll make a soft start. You're very welcome this morning to the latest in our series of webinars with our patrons, Selig. And as ever, we're very grateful to Selig for their support and their interest in the construction industry and all the topics that they've discussed with us in the past. This morning, I'll be introducing Darren Marley, who's a senior associate with Selig, and Darren will be taking us through topics of investment, joint ventures, mergers and acquisitions. But just a reminder, while I have your interest, next month in November, we will have the rather sobering topic of fatal accidents at work and what to do to protect workers and your business. And in December, we'll be doing the topic of time-related claims. So all of these topics are on the CEF website under events. You can book them all now if you want to get them into your diary, but we will, of course, keep you updated of events as they come up. But I think we have most people logged in now. So Darren, good morning. Thank you very much for agreeing to take this topic this morning. And I'm going to hand over to you. During the topic, we'd ask you to raise questions through the Q&A function. You'll find that at the bottom of your Zoom screen. And you can raise questions through Q&A. Only Darren and I can see them, so you can ask anything you wish, and I will pose the questions to Darren at the end.
Hopefully nothing too difficult, Mark.
Nothing too difficult, Darren. No trick questions, nothing contentious. Absolutely not. So Darren, you're very welcome. I'll hand over to you and we'll join up again at the other side.
Very much, Mark. As Mark said, I'm a senior associate here in the Selig corporate team, specializing in corporate M&A law and investments. For those of you who don't know Selig, as the slide says, we're a local and independent law firm. This is something we're very proud of, especially given the huge influx of English and ROI firms into the north over the last few years. We pride ourselves on our customer service and each of us being experts in our respective fields, allowing us to deal with any case that we get struggle on, whether that be our litigation team, employment team, or myself and the corporate team. Our 360 approach means our clients and you on the call have access to our full specialist teams who can provide tailored advice specific to your needs. Basically, Selig is a one-stop shop for customers and their business needs. We're a corporate law firm. We don't deal with criminal or stuff like that, but bar that, we are a one-stop shop for all of your needs. The sort of topic of today, focusing on, there's sort of three aspects: investments, joint ventures, and M&A. Dealing firstly with the investments angle of this, there's two ways in which an investor traditionally makes an investment into a business. By way of debt, this is via loan notes, convertible loan notes, some sort of debt instrument, or secondly, by way of equity. In essence, taking a piece of the business in return for cash or assets or some other consideration. Looking predominantly at the equity piece, this is what we sort of have termed as the Dragon's Den dilemma, as basically as what you see on the show. It comes down to two parties fundamentally agreeing how much a particular chunk of the business is worth. Like in the show, that when you're in the den, you start with, I'm looking for 100,000 for 10%. It's those two figures that sort of is the Dragon's Den dilemma, as we refer to it. Prior to making any investment, debt or equity, an investor will seek due diligence a company, your business. They'll review your key contracts. They'll look at your age profile of your staff. They'll check the financials, obviously. They'll review the business plan and the future projections of the business. This diligence allows an investor to assess the risk associated with the business, and they ultimately decide whether the potential reward outweighs the risks. The earlier it is in its life cycle, this being the company, startup, or heavily sort of aged business, the earlier it is, the higher the risk. And with that, it traditionally means an investor will seek to take a larger cut because, in essence, it's giving you check and it's a bigger gamble. Like looking at these sort of when you go to actually document, so from my perspective, the lawyer's perspective, the documentation required, and the two fundamental documents for an equity investment are the investment agreement and the articles of association of the company. Then from the debt position, the loan agreement or the debt instrument, like I said, convertible loan note, a loan note, etc. So as part of this chat, what I'm going to be focusing on is walking you through the key legal documents of an equity investment, which is the area I specialize, and the sort of key considerations that I see them dealing with on a day-to-day position. The investment agreement is a document under which the parties agree how much will be paid and how many shares will be issued to investors. On this point, it's important to note that whilst an investment can be made by the sellers or the current shareholders selling part of their stake, which is known as like taking money off the table, is what people refer to it as. It is most common that investors, when they come into business, will seek to have new shares issued to them, as the investors know that these shares have no previous owner, and as such, they're clean, and that reduces the risk profile with these shares. In essence, it stops the risk associated with a current shareholder having charged them to a bank or having actually transferred them to somebody else, etc. They don't have to carry out any due diligence. The articles of association of a company are the company's constitution, the rules of the company which binds the company and its shareholders. They vary from company to company, but are in essence a rule book that must be followed by its members and the directors on behalf of the company. These are read side by side with the investment agreement, and basically when you put these together, that is what is termed as the equity documents when an investor is making an investment. Should an investor wish to put its money in by way of debt, there are many mechanisms by which this can be done. For example, a traditional loan agreement, loan note instrument, etc. Investment by way of debt is traditionally secured over the business's assets, or on certain occasions by personal guarantees. So the way we all have mortgages on our houses, when somebody invests by debt, they traditionally take a debenture over the business and its assets. And in certain extreme, in my view, people do seek personal guarantees depending on the risk that they're taking and whether or not the company is a good target, or if the actual person has more assets that they can go after, in essence. Whichever mechanism an investor decides to use will primarily come down to what type of investment or return that investor is seeking to achieve. And some investors will actually invest in a mix of both debt and equity. For example, some of the bigger active funds such as BGF, British Growth Fund, they do a mixture of both traditionally. Large equity investment, but they also follow up with loan notes to guarantee them a sort of running return. Due to the specialist nature when it comes to sort of the debt aspect of debt financing, all corporate law firms, including Selig, have a specialist banking team. So I won't be going into the minutiae of like the loan agreement, key considerations for that today, as that's something that my colleagues would be dealing with. And if necessary, CAF would be happy to put something on for you. Today, I'll be the one to focus on the key aspects of the legal documents for an equity investment. So looking over the next two slides, I'll be looking at what I believe personally are the traditional negotiating points that come up on an equity investment and also on any corporate joint venture. So that means even like the sort of joint ventures you go into in your day-to-day businesses, as long as it's through a corporate entity, a partnership, or something like that, these are the key sort of fundamental issues that I see coming up in negotiations. First things first, when an investor is putting money into a business, both the investor and the company will need to consider what type of shares will be issued. What I mean by this is that companies can have multiple share classes, and it's not uncommon for an investor to seek enhanced rights in comparison to others. So when you first incorporate a company, traditionally people incorporate them with 100 ordinary shares of a penny or a pound, but you can have A shares, B shares, Selig shares. It doesn't really matter, they're just names. But where the differentiation comes down to is what the rights are associated with those shares. The main rights to be considered are voting rights. Well, the shares issued to the shareholder grant that shareholder the right to attend and vote at shareholders' meetings and on shareholder written resolutions. Dividends rights. Will the shares carry rights to dividends? And if so, should the other classes of shares, or should these shares be the only ones that have that right? And then the other main one is a return on a sale, or actually on a sale or on a liquidation of the company. Will the shares carry the right for the shareholder to obtain a cash return above what they've paid for them? If so, will this be pro rata, like rank equally per their shareholding, with the other shareholders, or will they rank behind them? I.e., will they get a preferred return or something like that, sort of bringing in a waterfall mechanism, as it's known. The above rights are normally heavily negotiated and vary from deal to deal, as an investor may seek to have a right to preferential dividend over all of the shareholders, or a minimum or preferred return on a sale to ensure that its investments further secured. So, for example, if an investor puts £1 million into a company, it may say that the first $1 million on the sale, for example, goes to it, and then say the business is sold for 10 million, the other 9 million will be split pro rata. So that's its preferred return. It could also require that if it's £1 million in, the first £1 million of dividends are paid out to it first, and then only after it has received its £1 million of dividends, the other people become entitled to dividends. These are basically just ways in which a investor can provide itself with some security around the investment it's making. The above those three mentioned share rights are those that people focus on first, because they're the specific rights associated with the share, and are included within the Articles of Association of the company. However, the Articles of Association detail every imaginable right that a shareholder may have. Given that everyone who owns shares in the business wishes to either sell or transfer these shares at some point in their life, whether to family or elsewhere, there are 3 other share rights that I would like to summarize for you, and they all relate to how shares can be transferred by a shareholder to another party. Dealing firstly with preemption. This is the principle that the existing shareholders in the company should be offered the shares that you wish to transfer as a shareholder to them prior to them being offered to someone else. So the party that you're, forgive the phrase, but you're already in bed with as such, that they all get offered the shares before they can go to other people. This is a generally accepted sort of principle, and there's very detailed drafting included within Articles of Associations to ensure that there's a clear step plan as to how this process works. So traditionally it's offered to all other shareholders first. Those shareholders have, say, 10 days to decide whether or not they would like to take the shares off you at the price you're suggesting. Say only 50% of them say yes, then what happens is the excess shares which weren't allocated on the pro rata offering are then offered back to the shareholders who had said yes to you. And then only if there's any shares left after the second offer can they then be offered to a third party. That's the sort of normal mechanism. It does get slightly more nuanced than that. Side by side with this concept of preemption is the concept of permitted transfers. This is basically a concept to counteract the preemption rights that we just discussed. It's common practice to detail a list of transferees, those who receive the shares from you as the transferor, that a shareholder can transfer their shares to without the consent of any other shareholder and without having to adhere to preemption rights included in the articles. Permitted transfers are traditionally allowed to ensure tax efficiency for the shareholders. So for a company, inter-group transfers within its group are allowed, and for individuals, it's normally allowed to family trust, direct family members, spouses, etc. Conceptually, there's traditionally, traditionally there's a clause in there which says that if any of the individuals or the group within the company's group exits or is no longer a permitted transferee, then the shares are returned to the original person. The last sort of transfer right I want to touch on is what's known as the drag and tag along rights. This is the most contentious of the three. The drag along is the most contentious of the three sort of topics that I've mentioned. In essence, the drag along does exactly what it sort of says in the tin. It allows a requisite percentage of shareholders, normally say in excess of 70%, because it needs to be quite a significant majority, to force the minority, so the rest of the shareholders, 30%, to transfer their shares at the same time as they wish to, at the same price, and at the same price, to ensure that the minority shareholders cannot frustrate a good offer that has came in. So in the real world, if 70% of the shareholders have been approached at what they believe to be a very good price. And sorry, to be very clear, the offer must be coming from a bona fide third party. That means somebody who is an actual, not unconnected party and traditionally at market price. If they approach at least 70%, then the principle is that 70%, if they genuinely believe that's a good deal and they want to sell, and the offer has came in for 100% of the business, they have the ability to force the minority, so drag along the minority on the same terms and the same price and the same deal, so that no one is sort of discriminated against. This right is there, in essence, to protect the majority shareholders from the minority, preventing a sale of the company when they feel it's right to do so. On the flip side of that, there's the drag along right. A tag along right traditionally exists when a simple majority of its shareholders, i.e. just over 50%, so 50.001% of the shareholders, decide they want to sell their shares to a purchaser at a price that doesn't interest the remaining shareholders to exercise their preemption rights. So they believe it's higher than normal, so they won't exercise their own preemption rights to acquire the shares. In this circumstance, one of the minority shareholders can decide that as a change of the landscape of the shareholding is coming, so that change of control of the business is coming, that he too wants his shares purchased on the same terms. This right there is basically to protect the minority from being left in the position that they are in a business with a majority shareholder with whom they didn't personally choose to get into business with. So having settled on the sort of share rights during the negotiation process, the focus shifts to what level of control the investor / the current owners desire to have over the company and its business. This, of course, comes down to what percentage of the company the investor's taking on, or what percentage of the company the current shareholders are retaining. However, the key areas that are considered by both parties are in relation to the directors, and what reserve matter or consent matters are fundamentally agreed between the parties. Looking firstly at the board composition. So there's a number of rights that I'll touch on here, but in essence, when investors come in, or when the company as it currently is ran are negotiating, the board comes down to the board are the day-to-day decision makers of the business, and that is where people look to put their foot down and have some control over to ensure that either their investments are protected or the company can continue to run as it has done successfully up to that date. The basic concept is that an investor will traditionally seek to have some sort of involvement or control of the board, as it's the decision maker. Normally, when an investor comes on board, the parties will agree that a chairman, like a formal chairman, will be appointed out of the current pool of directors. The big question at that point is whether or not the chairman gets a casting vote. So in the circumstance where the board is tied, so there's 4 directors and it's 2 and 2, does the person who is appointed as a chairman have the casting vote? That is a sort of 50-50 position, I would say, and what I'm seeing at the minute. A lot of people like the chairman to stop what's known as a sort of stalemate, but the other way around that is just to ensure that your board is a 3 and a 2, or you never have a sort of level board as such. The next point to look at is the director's appointment and removal. Depending, again, this all depends on the sort of level of shareholding that an investor will hold at this time. And depending on that level of shareholding, investors or the founders themselves may seek to have what's known as an enshrined right to appoint their own director. So under company law, the principle is that 50% or more, a resolution of 50% or more of the shareholders can appoint and remove a director. The removal of a director gets very complicated and there's a process, but it is possible with a 50% majority. But it is possible to enshrine within the Articles of Association the right for a shareholder, a specific individual, whatever the case may be, to have the right to appoint a director sort of indefinitely. Traditionally, you see it tied to their percentage shareholding. So for so long as Selig hold 10% of the shares in the business, they have the right to appoint 1 executive director to the company. So that allows, by seeking this enshrined right, it removes the risk of the 50% majority removing the investor's director from the board. So that's something that regularly comes up. It's quite common, but then the negotiation goes as to what percentage do people think that right should be sort of attached to. The next point is as to the quorum. So as I'm sure you all know, quorum for a directors and shareholders meeting is dictated and set out in your Articles of Association. The model articles provide that a directors meeting must have at least 2 directors, but that varies as to the size of the business and who should be involved. Again, subject to the percentage holdings of the parties, it is very common that an investor will seek to have the quorum require the investor director at the meeting, so that no board meeting can take place without the investor director being present. So in the example that I used of 4, that, you know, of the 4, the quorum's 2, but one of the 2 must be the investor director. Again, it's just a bit of security over the running of the business from the investor's perspective. Again, from the company side, you can seek to have the same thing, and that normally, traditionally, when this gets brought up, they go hand in hand. An investor will say, I must form part of the quorum, and then the management team or the fundamental shareholders will then also request the same thing, that they must also form part of the quorum. What you have to be careful about, and I know Glenn Watterson, my colleague, did the corporate governance discussion last week, but you have to be careful at that point that you don't risk there ever being a position where if one of those 2 people are quite inactive, that you find yourself in a stalemate and you can't carry out board meetings, because that can be very difficult. And then finally, and it's just a very short point on this board composition point, it's the concept of an observer. So sometimes when you're negotiating with an investor, they'll say, we want these quorum rights and this director's appointment rights, and they won't be taking what you believe to be a significant enough stake at that time to justify them having such strength over the board. Or these rights also apply, to shareholders meetings, that they could seek to be required for a shareholders meeting example. And what happens for people who don't have the sort of material percentage shareholding or power is that they then traditionally request to appoint an observer to the board. An observer can either be a speaking observer who's allowed to voice their opinion, which doesn't have to be followed, or you can be very clear and say, we'll allow you to have an observer who will get notice of the meetings and can attend the meetings, but they can't speak at them. And that's quite common, because if you're not a director, why should you have a say as such? Moving on then to what is known as the reserve matters or consent matters. These are the most contentious matters that come up on any sort of joint venture, or, you know, as we're looking now at the investment agreements, these are the most contentious matters that come up, because it's in essence a list of matters that the company and the directors cannot do without the consent of either the investor or an agreed percentage of the shareholders. So, for example, you cannot, without the consent of Selig, you cannot spend more than £50,000 on capex in any financial year. These are very emotive, because the company's current board have ran the business, and the current shareholders have ran the business to the point where it has become a successful business. It has got to the position where the investor has done its diligence and has wanted to put its money in. So the current management team are traditionally very reluctant to give up any power. On the flip side, you have the investor who's going, I just written a £1 million check, and in essence, I need to know that you aren't going to spend that incorrectly, or you aren't going to do something that I'm not happy with, and enter into a very risky contract, for example. The position with reserve matters is heavily negotiated, and traditionally you end up with different scales. So, you know, one will be absolutely cannot, you cannot do this without the consent of the investor. Then you'll end up with interims that, you can do this if you write to the investor and they don't reply. And these get heavily negotiated. And the list of reserve matters, like, for example, our precedent sort of shareholders agreement questionnaire, investment agreement questionnaire, I think we have a list of like 35 matters, going from things such as change the company name, pay any dividends, take on any debt, varying to, changing the registered office, It really depends how nuanced or how much control somebody will seek to have over you. But in essence, when you come to go down an investment route, that's what you will find yourself sort of having long discussions with either your management team now or with the investor over. The final point I wanted to touch on, and this doesn't apply so much to the joint ventures aspect, but it applies certainly to the the investment agreement position, is restrictive covenants. Obviously, there are material concerns to any investor that when it invests, it is putting its money up, and it needs to know that you're going to do the best that you can for that company. And as part of that, even if when the investor comes in, the management team aren't happy and decide to move on, what they require from the management team is comfort knowing that the management team can't stay in the same industry, cannot compete with the business that they've just put their money into. They're normally, they follow quite a similar form. So they normally say you can't compete against the company and the business carried on by the company in the territories in which it relates. You can't solicit customers from the company. You can't defame the company or its owners, and you can't solicit staff. That's the sort of traditional manner, but I just want to touch on it so that it's, if you are going through this process, that it's not something which takes you sort of catches you off guard, because obviously you are probably all restricted under your own employment contracts anyway, but it is an additional one they'll seek to add to it, because restrictive covenants under an investment agreement or a share purchase agreement are traditionally more enforceable than those under an employment agreement, because you can properly point to a valuation, like a large sum of money that needs protected. So finally, and apologies, it's not on the slide. But as we're talking about sort of key things to be aware of, as part of the diligence process that I mentioned earlier on, the investors will look into key contracts, financials, etc. But what they will seek from the management team traditionally, if not some of the shareholders, is protection warranties from the management team, so management warranty deed, which basically is a set of statements which are promises from the management team, confirming that the information provided to the investor is true, accurate, and not misleading. So in essence, this is a way that the investor puts somebody on the hook to know that what has been given to them is accurate and up to date. When it comes to an investment, traditionally it's the management team who give these, and the norm is that your liability is capped at, say, 1 to 2 times your annual salary. So it's an incentive to you not to be, misleading them, of course, but it's not any more than that, because the view normally is that you haven't really cashed out, or you're traditionally the management team are still working for a reason. In the event that the investment is made by sort of an acquisition rather than a share purchase, the liability they'll seek is what they've paid you, and you'll be on the hook for what you've been paid. That's the sort of norm. So then, leaving behind the investments, so when it's sort of fresh in your head, please feel free to drop in any questions or whatever you have. But leaving them behind and then moving on to the joint ventures. The term joint venture has no specific meaning in law. As the slide says, it describes a commercial arrangement between 2 or more economically independent entities, which can effectively be slotted into one of 4 structures, that being a limited liability company, limited liability partnership, an LLP, a general partnership, so 2 or more people carrying on trade with a view to making a profit, or simply a purely contractual, what can be known as a cooperation agreement, so that there's no sharing of assets and stuff. It's just a contractual arrangement. Broadly, the 4 forms reflect varying degrees of integration of the interests of the parties within a joint venture. The corporate structure typically involves the vesting of all trading activities and assets and liabilities relating to the JV into one single vehicle. And that's sort of looking at your limited liability company, your limited liability partnership, or your general partnership. On the other hand, where the association is purely contractual, so the cooperation agreement, there may well be no pooling of assets, no pooling of staff used by the participants in the joint venture, and no general sharing of revenues and costs. So it is purely a collaborative contractual arrangement. Indeed, some collaborative ventures probably do not have sort of sufficiently common elements to rank as joint ventures. They end up basically being service contracts, but people call them JVs. Whatever the proposal, it's very important that I say that like Selig aren't tax advisors, and you should always seek tax advice from your accountant or corporate finance or whoever before entering into a joint venture, because there are specific details that you should really be taking time on and ensuring that you get right. Broadly speaking, the first three options, the limited liability company, the LLP, and the general partnership, all negotiate the same principles that I sort of highlighted before for the investment agreements. They look at power, control, profit sharing, how do you get your money out, that sort of thing. So having dealt with those points already, I'm going to look on the next slide purely at the contractual venture, because I understand that can be quite common within the construction entity where it's two parties agree that you need each other's assistance to, say, land a tender. So I'm going to look at sort of what I've come across as sort of the common themes within that. So looking at the cooperation agreement, in pure legal terms, the simplest form of association for a joint venture is an arrangement under which the participants agree to associate as independent contractors. Excuse me, rather than as shareholders or partners in a legal partnership. This type of agreement is often referred to as a consortium agreement, cooperation agreement, or a collaboration agreement. Here, the rights and duties of the participants as between themselves and third parties, and the duration of their legal relationship will essentially derive from the position of a joint venture agreement, so the cooperation agreement, and associated agreements, which make part of that, and the general common law rules. The agreement will specify the scope of the venture, the obligations, the commitment of the individuals, as well as provisions covering the financing of the venture and the entitlement of the individual participants to the fruits of the venture, whether that be income or alternative benefits. Looking at the sort of liabilities, risk and loss/risk apportionment perspective, not being a partner in the legal sense within a sort of this sort of cooperation agreement perspective, a participant in a purely contractual arrangement will not have a statutory responsibility for the liabilities and obligations of the joint venture and for the acts or omissions of the other party. The partnership or within business, within a company, you will do, because obviously you're sharing that risk. However, even though that's the case it's not the case, in a cooperation agreement, any participant will be exposed to claims and liabilities, which, because there's nothing else in there, could ultimately be unlimited, subject to how you structure it, as a consequence of both its own activities and the activities of those other participants. So if you do enter into some sort of agreement to help each other with a project, you could be the one potentially on hook for the works done by the other person. So whilst you haven't expressly assumed those liabilities, you may end up being on the hook for them, or vicariously liable under the joint venture arrangement. To the extent to which an individual participant is responsible for the activity of other participants will depend on the authority given under this cooperation agreement to bind it and the others under the agreement. In particular, you should be looking at your liability clauses, whether or not there's indemnities in there so that you can cost recover on a pound-to-pound basis, etc. On some projects, the work may be carried out through a series of contracts, subcontracts, etc. Some liabilities being shared, others being borne purely by you, the main contractor. But ultimately, what you need to ensure is that throughout whatever the process is, 5 contracts, you just need to protect yourself and ensure that there's back-to-back indemnities, back-to-back warranties, whatever the position may be. As in the case of a partnership agreement or shareholders agreement, each participant will be interested not only in the ability of its co-participants to perform commercially, but also their relative financial position. So when you enter into all these arrangements, as you would when you're bringing on a new sort of shareholder, you need to make sure that they can stand over and actually deliver what they are. And if they can't, what sort of mark/target are they, should you fall into difficulties? when it comes to the profits, like just as I said a minute ago, I'm not a tax advisor, but I'm just going to touch on a couple of the key points. When it comes to sort of looking at profits and how you take money out of a sort of pure contractual relationship, it will come down to your relationship with your accountant, or the advice, sorry, from your accountant and your tax advisor. Basically, if the businesses that make up the contractual JV are separately owned, which they should be, and controlled, and each joint venture party bears its own cost, it will usually it follows that the net profits of the joint venture are not shared, but rather accrue separately to the participants. Each participant will be subject to corporation tax on the profit which accrues separately to it, and as it bears its own costs, it will make a separate claim for any tax relief arising from the incurring of those costs. Consequently, each participant carrying on a trade will separately claim its own appropriate revenue expenditure as a deduction in computing its trading profits, and will make a separate claim for capital allowances in respect of its own qualifying expenditure. As I said, that's more me just filling in to make sure that it's a full picture, but that sits sort of with an accountant or a tax advisor. Looking next at sort of the assets of the JV, as sort of alluded to already, the assets of a cooperative JV, a contractual JV, sit separately with the, say it's two parties. Like, you own your assets and I own mine, and that's sort of, we agree to do work together, but we keep our assets separately. So it is common parties retain their own assets into the venture. However, should there be a need for a new asset and you agree to split the cost, or you agree to acquire this together, that should be carefully documented, because in a contractual joint venture, the position is that you should, you normally don't mix your assets, and that's how you keep the clear divide. Then the final point, sort of just to touch on when it comes to a cooperation agreement, is just to touch on the suitability of this, because joint ventures, from my perspective, do fall in sort of two categories. One, it's just a pure contractual, and the other one is the LLPs, the shareholders agreements, etc., the corporate ventures where you actually join together and create a new entity. The simple form of contractual association is suitable, in our view, where the parties wish to avoid the relative formality of a corporate structure and the degree of integration and interdependence and associated liability problems, basically represented by a legal partnership, while wanting, for particular reasons, to have direct interests in the business that you are joining up to do. A cooperation or collaboration agreement is often the basis for joint ventures in relation to property development, tenders and construction contracts, goes as far as oil and gas exploration, or other projects where, for example, the participants make their own contributions, but at different stages throughout the project. So as I said, this type of JV was the one I wanted to touch on, because I know that it can be quite common in your industry, but I do know that you regularly dabble in the other ones, but I felt it was covered off in the sort of investment agreement angle. So again, if there's anything you wish to ask, please do so. But otherwise, I'm just going to move on to the sort of the last piece, which is a very, very quick summary on M&A, buying and selling businesses. This is obviously the sort of the main bread and butter of our industry here in the corporate world in Northern Ireland. And as part of that, it is what we do day to day, basically. But as part of that, it is obviously heavily detailed, heavily negotiated. And whilst I'm not touching on everything here, please feel free to reach out to me or another member of the corporate team in here to ask any details which you don't feel that I covered. I'm going to cover off these sort of 6 what I think are key points just to note to you as the sort of the parties involved in this. Some of them are like, so the second two, the 2, 3, and 4 are sort of quite detailed in terms of like the legality around them, but they are important if you are considering making an acquisition or if you've been approached, because there are multiple options out there before you even get to that term stage phase. Again, you should be seeking tax advice in relation to any proposal you want to make or you are receiving, because ultimately you want to look after your own. So starting first off, just with the purchase price / valuation point, like I'm not going to pretend that this is something that sits in my court at all as a corporate lawyer. these are sort of covered up by accountants and by corporate finance advisors, but there are multiple ways for a business to be valued. For example, a multiple of EBITDA, multiple of EBIT, net assets value. But next, it comes down to it, and ultimately comes down to what a willing buyer is willing to pay for the business, because that is the purchase price, whatever somebody's willing to pay. Corporate finance advisors are the specialists in this field, and if you are interested or considering selling, like, corporate finance advisors can actually assist you in showing you the different valuation mechanisms for your business to allow you to sort of work out what your company is worth. Moving on then to asset sale versus share sale. This is sort of one of the key points. The sale and purchase of a company or business is carried out by one of these two mechanisms. The commercial reasons for pursuing a business/asset sale or a share sale will come down to tax implications and your preferences in terms of what suits you at that time. Taking a sort of a share purchase, share sale in the first instance, this is like from the seller's perspective, this form of transaction provides the seller with a clean break from the whole company, including its liabilities, and that's sort of the fundamental point. You leave behind everything. You walk away, subject to the terms of your deal, but you walk away. First glance, this is an attractive perspective for a seller. However, just to note that, as we touched on before, you will be expected in this circumstance to go through extensive due diligence, provide detailed warranties, and where appropriate, provide indemnities around the liabilities associated with this business. This is all to ensure that the buyer's risk for taking on an historic business, like company taking on the shares and the liabilities, is covered as far as possible. This can obviously lead to protracted negotiations, as the terms of the warranties on the wider deal take time to finalise. By transferring your shares in your business and your company, you also transfer staff without having to go through all the transfer CHIPI regulations, transfer of staff rules. You transfer your contracts subject to change of control provisions, which will be dealt with in diligence. Your contracts go, your staff go. If there's property in the business, if there's assets in the business, they all go there and then. It's not, an individual sort of list of items. From the buyer's perspective, the risk here, as I've sort of touched on with the seller already, is that you buy the company warts and all. You take on, if the company's established in 1988, you take on its historic risk, subject to limitations of claims being allowed, etc. The advantage being to a buyer is that, subject to a couple of conditions, those change of control, etc., is that the business continues with fluidity and the company processes remain as you were, with no immediate actions needed. You don't need to consult with staff other than to introduce the new buyers. The main point, as I said, is warts and all, the liabilities now lie in your hands. So as a buyer, you need the diligence, you need to take the time with your financial advisor and your lawyer, create a good questionnaire, and build down into this company to ensure that you're making the right acquisition. Other benefits, like to do with this from the buy side, are that, from a cost perspective, buyer pays 0.5% of stamp duty. It can be, subject to the deal, quite high, but it's not as if you're taking on business and assets and you can pay a sort of a higher tax bracket. Moving on to now that we've talked about share purchase, moving on to an asset purchase. Again, an asset purchase differs for one reason only. You basically have the opportunity to select assets, liabilities, and be picky. You're not selling and taking on warts and all. So from a buyer perspective, the key considerations of this approach are: you can negotiate which assets and liabilities are transferred and therefore mitigate your exposure. So that part of the business that you're looking at isn't profitable, you can leave it behind and only take out the profitable bit as the buyer. Some of the sort of drawbacks are, because it's an asset sale, consents will be needed all around the show, whether that's under a lease for the property, whether it's through your customer contract. Because the contractual party will change, consents will be needed. As alluded to, CHIPI will kick in, and subject to the buyer changing the terms of price and payment of employees, etc., you may have to follow the full consultation process, which adds time and becomes an arduous sort of process. From a seller's perspective, the material benefit is the flexibility that allows the sellers to choose what assets it puts up for grabs. and which it obviously chooses to retain. Of course, the main drawback being that it may not be able to shift any skeletons it may have in its closet, and it'll end up sitting with them and have to work with its own advisors to get rid of them. But like when I talk about the flexibility of the seller, it's very common that asset sales are used within groups or within one business to dispose of part of a business to allow it to focus on its primary business. So, for example, you see that one part of your business is flying and you want to dispose or move on another bit, which is doing okay, but you don't have the time. You know that if you focus on the other bit, it can grow exponentially. You can, on an asset sale, you can pick that bit that you don't want and dispose of it by itself, and it's leaves you with the business that you want to retain. The next point is in relation to deferred and contingent consideration. Once you've settled on the valuation for your business or assets, the next bone of contention as a buyer is ensuring that you structure the payment in such a way that suits you from a cash flow perspective, but also from a risk and apportionment perspective. Obviously, from a seller's perspective, the goal is to get all the money up front and walk away into the sun as clean as possible. But this is very rare, as normally the buyer seeks to structure their deals with some sort of later payment. Deferred consideration, just to be clear, a true deferred consideration is where the buyer agrees to pay X on day one and Y at a set later date. There's no conditionality on the Y payment. It's simply a payment that will be made at a later date. This is normally from a cash flow perspective of the buyer, and so long as it's on a small percentage of the purchase price, most sellers are open to this, given the fact that there is a large sum of money passing hands. On the other hand, there's a concept of contingent consideration, the most common of which is referred to as an earnout. Okay, this is when a future payment owing to the seller as part of the purchase price is conditional upon something occurring, whether this be the seller staying in the business for 12 months, so that they expect a good handover, they want continuity of business for the customers, etc., or whether or not it is actually based on the company's performance. So, for example, you buy a business and you say, I expect 12 months later that the EBITDA is still at no less than 500,000. That is the two most common. As an earnout, while it's common, it is a contentious beast. As from the sell side, the price is the price. So when you think about it, when you get your company valued, that is at that date's price. So why, from a seller's perspective, should any of it be based on the business still running at the same level or at a better level than what it was on the day that you passed it over to the buyer? Like, is that not the buyer's responsibility? In essence, is what the sellers always say. Whilst I am very sympathetic to this view, the fact of the matter is the buyer is writing the check, and an earnout is a way of the buyer retaining some security of this investment. And when it comes down to it, that could be to allow the bank to fund them, that could be allowed the investment committee to approve it. Traditionally, what comes up for grabs is what the earnout is and how long it will last. The shorter the better, and the less the better from a seller perspective. The longer and the more, obviously, from the buyer. Moving on then to completion accounts versus lockbox. This sort of sits side by side with the purchase price valuation piece, but it does come down to quite nuanced drafting within a share purchase agreement or an asset purchase. Well, this only applies to a share purchase agreement normally. There are two ways in which the deal can be structured when it comes to agreeing the purchase price. First being lockbox. Lockbox is a pricing mechanism under which the parties calculate and agree the price payable for the target based on a set of pre-completion accounts, ideally and commonly no more than 3 months old. Sellers prefer a lockbox account because they have comfort in knowing that the price is locked and that it's not subject to adjustment. So in essence, a lockbox means that you are looking at a set of accounts 2 months old and you're having them heavily diligenced before completion by the buyer, and they all agree that they're in order, and that locks the pricing, and that's what the lockbox refers to. Buyers mitigate the risk of this by the risk of a pre-completion set of accounts by including what is known as a leakage indemnity. So this basically provides the buyer with protection that should the seller during the 2 month period from lockbox date to completion date have taken money out of the business outside of the ordinary course, then it is indemnified for this amount. So the sellers give themselves a dividend, which they shouldn't have, for 50,000. That comes off the purchase price, and you don't have to pay it because you're indemnified for it. It's important to note that on a lockbox deal, risk for the trading business passes to the buyer on the lockbox. So the benefit or the risk passes on the lockbox date because you're agreeing the price at that date. Completion accounts. In this circumstance, the purchase price is determined on a set of the purchase price payable on day one is determined on a set of estimates of cash, debt, working capital, etc., and a set of completion of accounts are completed after the completion date, made up to the completion date, showing the accurate final position of the company. Okay, so what that means is, unlike a lockbox accounts, this means that there is a level of certainty about what the position of the company was that you have just acquired. So there's no ambiguity around this. This method is preferred, unlike Lockbox, this method is preferred by buyers as they get this certainty over the financial position of the company just purchased. But it does mean there's significant negotiation around who'll prepare these accounts, buyer's accounts, seller's accounts, what accounting policies will be applied. Do the buyer and seller have different views on debt, for example? What is good debt, bad debt, which can obviously lead to longer negotiations. The next 2 points are quite short and allow me to wrap up. I just wanted to highlight that obviously under an M&A deal, the main protection and contentious parts of a deal are the warranties and the indemnities. Warranties are promises given by the sellers to the buyer, and if inaccurate or untrue, basically mean that the sellers can be sued. Okay. Warranty serves two purposes. One is to elicit information. So you get a page, 20 pages of a warranty saying things like there's no litigation in the business. The assets are all the assets needed to run this business. You get 20 or 30 pages of statements like that. And if they're untrue, you get the ability to write what's called a disclosure letter and tell the buyer that they aren't true. And that allows them to garner information about this business. The second thing that warranties offer is protection around the purchase price. So in essence, when you give a statement such as there is no litigation against the company and you don't disclose against it, then the buyer knows that there is no litigation. And if it turns out that that was untrue, he can sue you. Okay. Indemnities. These are very emotive because indemnities are traditionally, our buyer solicitors seek to have them uncapped and last for 7 years, long periods of time. Indemnities are for specifically identified issues during due diligence. So using the example of the litigation warranty, if the disclosure that comes against that warranty is that there is an employment claim outstanding that may not be covered by insurance, then the buyer will seek an indemnity to say, if that comes to fruition, you'll pay me back every penny of that. They can either do it by indemnity or a holdback. Sometimes they go hand in hand. So they'll set you'll agree an amount of say 87,000 and it'll be set behind the highest, and you set that behind and it comes at a later date if the claim doesn't come to fruition. And then, sorry, just to finish off, the last point is just to touch very briefly that under an M&A deal, as the seller and as the buyer, the last thing or the main thing that you will negotiate is around the limitation of the seller's liability. This in essence comes down to what you will agree the seller will not be liable for. So they won't be liable for anything they've disclosed to you because the buyer is aware of it. Then the normal things that are looked at are time limits. How long will the warranties last? So normally you look in between anywhere from 18 to 12 to 24 months is sort of the norm. 12 being short, 24 being long, 18 is normally where you fall out. For tax indemnity, tax covenant, that lasts 7 years. And the idea of a tax covenant is you draw a line in the sand and the seller is responsible for all pre-completion tax and the buyer for all post-completion. And that's 7 years because that ties in with the 6-year look-back window that HMRC have in the companies. The other sort of thing you obviously look for and negotiate is financial caps. So what will be the financial limitation? Will it be on cap? Will it be the full purchase price, 50% of the purchase price? And then at what level? So that the other two financial caps that people discuss are what's called the de minimis and the basket. What de minimis being, what is too small a claim that you won't bother bringing against the seller? So in the market, it's traditionally not 0.1%. So on a £1 million deal, £1,000, you won't bother them with anything less than £1,000. And then the basket is how many of those £1,000 claims do you really need to have suffered before it's worth you coming after the seller? And traditionally, that's 1%. Obviously, the bigger the deal, the less appropriate the 0.1 and 1% figures become. So that really just comes down to negotiation with your lawyers and your accountants, etc. And look, that's me. To be honest, I appreciate that was quite a stop-start summary of investments, joint ventures, and M&A, which each could probably have their own discussion point to go through a full sort of detailed analysis. But thank you all very much for your time, and Mark, thanks again for having me this morning.
Not at all, Darren. That's great. That's very, very comprehensive run through, and you covered a lot of ground there. We have a couple of questions which we'll get through just the next few minutes before we go. Firstly, you mentioned in terms of reserved matters, there was a list of 35 items. Is that something we can share? I
need to check that I can share my precedent bank, but yeah, like I like it, they're not uncommon, you know. But yes, like I'm happy to share it with whoever was looking at it. I think because it's a list of like they're not. Yes, that's fine.
Okay, well, we'll share your contact details obviously after this. In terms of the sector itself, have you a sense at the moment in this current weird world we're living in, is there much activity in the M&A sector? And is it, if there is it at the high level, large businesses, or is there still a healthy market in smaller businesses?
No, it's very healthy in Northern Ireland. Like we are extremely busy in Selig right now. And like I have a lot of friends in other firms in Belfast because I train with them, etc. And the whole market is very busy. We are seeing a lot of inward investment because I think COVID / Brexit, etc. You know, foreign people started to look in and realize there was value here. On top of that, you know, the tech market here is booming. It's a very, very, very popular industry, and I'd say over the last 12 months, that's been an industry in which we've seen a lot of activity in terms of M&A. As a result of sort of the whole COVID pandemic, we've seen quite a lot of sort of mergers, whereby, you know, there has been issues with companies and they've sort of came together and sort of consolidated in essence, particularly in the likes of the transport sector. You know, there's been some acquisitions within the construction sector, particularly, you know, picking up companies which were struggling because of their workbook not getting fulfilled, their contracts not being paid up. But generally in every sector, like, you know, like if I read you my list of files, it's probably over 10 sectors right now in terms of proper purchasing or selling right now.
Okay, no, that's very encouraging. The question here, and I think this might be straying into the tax area, so forgive my ignorance, let's say. The question is, in advance of a sale or a part equity sale, and given them entrepreneur relief of $1 million, should the person be looking at a share options agreement with senior staff that they might want to reward before they actually start a process?
So it's definitely a tax position in terms of like making sure it makes sense and the timing makes sense, because for example, if you go down the EMI option route, like they only last for 10 years, so your wider exit plan needs considered, etc. Throughout that. But I'm not going to say you'll definitely get it, but it's quite common on investment anyway, and with equity, that they are encouraged, especially with private equity buyers, they do and are very open to creating option pools to incentivize management to stay, because that is the norm. For a private equity house, they come in and they want the management team to stay. Every so often, they'll bring in somebody to assist and put somebody on the board. Very common, as I said, in the sort of the shareholders investment agreement piece. But in terms of the options, it can be quite common, but you should always look now to see if it's better when you're in control of it. That's my advice, but it comes down to tax, etc.
Grand. And just if anybody has a final question, do type it in now, because we will wrap up at 11. But the final question I have in front of me at the moment is just any sense, in your opinion, if devolved corporation tax was back on the agenda again for Northern Ireland, would that have an impact on the M&A? And I suppose we're looking south of the border and seeing changes in corporation tax levels there on a global basis. So any view on that, if we had that power locally, how it might stimulate the market or otherwise?
I don't want to be political, so no, but I just don't know what they would do even if it was devolved here. You know, I know there was rumors about it, them bringing it down in line with the south, but it's now came up to 15. So I don't know. I think any tax saving is obviously an incentive, but I think the big thing is what happens here on the 27th of this month, whether or not they go after this final £1 million of entrepreneurs relief or they increase corporation tax. The last rumours I heard on Ernst Young presentation last week was if anything happens, it's likely to or potentially going to be an increase to 25%. So, you know, like there's a lot of activity right now, particularly because they want them over the line to remove that risk. If that doesn't happen, you know, I think there'll be a lot of people looking to the next budget and wanting to see what they can do. I've seen there was a point about the family-owned business. Yes, like it can be daunting in a family-owned business. I have a family business. I didn't go into it, but my family-owned one. And the only thing legitimately, and I know it sounds like a bit of a selling point, but the only thing I would say was honestly, like, rely on your advisors. You know, we've all done this, whether it's Selig or your own, you know, whoever it is, rely on them. Do not be backward about speaking to them, expressing your difficulties. And in essence, you pay them for a reason. So get the advice that you need out of them. So
no, I think that's a good note to end on, Darren. It is a minefield, isn't it? So I think good advice is always well received. Thank you very much, Darren. That was really comprehensive. Much appreciated. We'll share your contact details afterwards if anybody has any.
No problem.
For Darren that we didn't raise up to now. And we, as I say, have a series of Selig webinars on our website. So we will see everybody again for the next one of those. But thank you all for joining this morning. And thanks again, Darren and Selig.
No problem. Thanks very much.